Howdy, y'all. Welcome to Liberty Call. Today is Wednesday, I almost say November, this January 11, 2023. Hope everybody's having a fantastical Wednesday out there. Apologize for not doing a broadcast yesterday. I had a bunch of appointments away from the office and just didn't make it back. And by the time I got home, just didn't feel like jumping on. But yesterday was an up day. Today, another up day in the markets. So I'm sure that the people who are bulls right now are really, really happy. The bears are probably frowny faced, but again, like I said, lots of greens across my screen here, mostly around the globe. Looks like the overnights were not quite as good in Asia, but all in all, pretty good Wednesday out there. So let's go ahead and if it's your first time watching, please give me some thumbs up, some likes, some shares, some subscribes, and I greatly appreciate it. And let's go ahead and dive into the numbers. Dow Jones was up 0.8% today, or 268 points, closed at 33,973. S&P 500 up 1.28, closed at 39.69. NASDAQ up 1.76, closed at 10,931. Small caps are up just under 1%. The VIX was up today, even though the S&P 500 was in the green. VIX was up 2.48. It's currently holding at 2109. Canada was up 0.63, Brazil up 1.53, Mexico up 1.55. Jumping across the Atlantic, Germany was up 1.17, UK up 0.4, France up 0.8, the Euro Stoxx was up 1.04, Netherlands up 0.79. Let's see here, this is Spain up 0.16, Italy up 0.72, Switzerland up 0.75, and Portugal up 0.28. Russian exchanges both in the green, MOEX up 1.27, RTSI up 2.88. And like I said, the overnights in Asia, Japan was up 1.03, Australia up 0.9. And in the Chinese markets, we do see some reds here. The Shanghai was down 0.24, the SESE component down 0.58. The China A50 was up slightly at up 0.07, DJ Shanghai down 0.26, the Hang Seng up 0.49. Taiwan weighted came in down 0.35. So like I said, other than the overnights in the Asian markets, everything else was in the green. Lots of markets are up over 1%, which, we'll take that as pretty good for now. But again, let's look at the chart here for the S&P 500. If we zoom in closer to here, we can see this resistance line. In the last 2 up days, we are right under this line of resistance. So curious to see if we bounce or if, we break through this. Like I've said on a number of occasions over the last year plus, we kind of get to this point and then the market loses steam and then it falls back and retraces back to where it was. And we have a lower low every single time, it seems like. So we shall see if, this current upswing we've been in since really, I guess, late October, it has stalled a little bit here in late December. And again, I'll be curious to see if it goes through this. But, looking here at the momentum indicator, it has fallen into the red again. And let's see here. But we do have, we do show that the lines are crossing here on the histogram. So again, it's kind of tough to tell where things are going to go long term. But we shall see what happens. All righty, let me get my stuff back up here. All right, let's go ahead and read through today's market recap and see what they had to say. S&P 500 rides consumer stocks higher as focus shifts to inflation data. Yeah, that report I think comes out tomorrow or Friday. And if it has a worse reading than expected, I imagine that markets are not going to like that, because then they're going to take that news as that the Fed is going to raise rates for longer, and that they have a much tougher hill to climb, which again, anyone paying attention can see that. But again, these financial reporters are big on trying to, wish things into existence, like, free money for borrowing and, lots of QE. So we shall see. All right. The S&P 500 advanced Wednesday, led by consumer stocks, just a day ahead of data expected to show inflation cooled further in December. Following recent data pointing to cooling inflation, including easing wage pressures seen in the December jobs report, investors are, quote, looking for further news showing inflation is headed lower in the CPI data, end quote, Wells Fargo said in a note ahead of the Consumer Price Index report due Thursday, so tomorrow. Economists are expecting that the Consumer Price Index to ease to 6.5% in December, year on year from 7.1%, supported by lower car prices, oil prices, and rent prices. Expectations for further signs of easing inflation pressures have buoyed expectations for a less hawkish Fed. Consumer discretionary stocks led gains in the broader market, as Amazon and Tesla racked up gains, with the latter announcing plans to expand its electric vehicle factory in Texas. The move comes in the wake of demand worries after Tesla recently cut prices on EVs in China, a key market for the EV maker. Travel and hospitality stocks were also boosted consumer stocks, with Expedia rallying 5% after Oppenheimer upgraded the travel company to outperform from perform as, quote, customer services, efficiency improvements, and successful cost-cutting execution, end quote, are expecting to boost margins. Alphabet and Microsoft, meanwhile, rose more than 2% and 3% respectively to lead big tech higher. Microsoft reported interest in investing in artificial intelligence startup OpenAI continues to spur optimism on Wall Street. Quote, with ChatGPT being one of the most innovative AI technologies seen in the industry, Microsoft is clearly being aggressive on this front and not going to be left behind on what could be a potential game changer, changing AI investment, end quote, Wedbush said in a note. Airline stocks were also in focus after the FAA lifted a halt on domestic flights following an overnight outage of a system used to send safety and flight information to pilots. More than 8,200 flights have been delayed and over 1,200 flights were canceled, according to flight tracking service FlightAware. The bulk of airlines including American Airlines, Delta, United, but Southwest was marginally in the red. Let's see here. All right, so that's everything on the news front for today. So I got an article here. It has to do with wholesale inventories. U.S. wholesale inventories rise strongly in November as demand falters. So another sign that the economy is cooling off a bit. So let's breeze through this and see what it has to say. U.S. wholesale inventories increased strongly in November, lifting the inventories to sales ratio to the highest level in nearly 2.5 years. As higher borrowing costs depressed sales, the Commerce Department said on Tuesday that wholesale inventories rose 1%, as previously reported last month. Stocks at wholesalers increased 0.6% in October. Economists polled by Reuters had expected that inventories would be unrevised. Inventories are a key part of gross domestic product. Wholesale inventories accelerated 20.9% in November on a year-on-year basis. Still, the pace of inventory accumulation has decelerated considerably from the robust pace in late 2021 and early 2022, in part because of improved supply chains and ebbing demand for goods as the Federal Reserve aggressively raises interest rates to combat inflation. There were increases in furniture, computer, and professional equipment stocks, as well as electrical equipment, metals, hardware, and machinery. But motor vehicle inventories were unchanged after rising 0.5% in October. Wholesale inventories, excluding autos, increased 1% in November. This component goes into the calculation of GDP. November's increase in this component suggests inventories could contribute to GDP in the fourth quarter after being a drag for 2 straight quarters. Growth estimates for the fourth quarter are as high as 3.8% annualized rate. The economy grew at a 3.2% pace in the third quarter after contracting for the first half of 2022. Sales at wholesalers fell 0.6% in November after being unchanged in October. Long-lasting manufactured goods accounted for the decline, with non-durable goods sales rising moderately. Long-lasting goods tend to be bought on credit. At November's sales pace, it would take wholesalers 1.35 months to clear shelves, the longest since June of 2020, and up from 1.32 months in October. Rising stocks of unsold goods are forcing some retailers to offer big discounts, which over time will help to lower inflation. So I guess the moral of the story is that retailers are not selling as much as they would like. They got a lot of inventory. So keep an eye out for good deals, whether or not it's, they said, what was the furniture, computer, and professional equipment stocks. as electrical equipment, metals, and hardware and machinery. So if you're in the market for one of those things, keep an eye out over the next couple of months. I would imagine, especially after the first of the year, a lot of these companies are going to probably slash prices. So keep an eye out for some good deals. When again, it's not just the stock market. When it falls apart, there's always good deals there. Same thing in the retail market. All right, last article here has to do with retirement savings. 17.5 million Americans are missing out on free money from their employers. Here's how to make sure you aren't one of them. The promise of free money is typically pretty alluring. After all, the stimulus checks Congress handed out during the early months of the pandemic were enormously popular. Well, not with people who understand economics. The more than 3 million people signed a petition last year calling for more. Yeah, of course, people who don't understand how money works. Yeah, free money, just send it in. Why is everything more expensive now? Mystery. Well, it's because you inflated the monetary base. That's why we're dealing with inflation. The stimulus checks are the problem. Swear. Do I have to buy everyone the book Economics in One Lesson by Henry Hazlitt? I mean, seriously, people. All right. So why then are 1 in 10 working Americans missing out on thousands in free cash that's available right now and has been for a long time? A 401k match from your employer is the closest thing many people get to free money, and studies show millions are missing out. That's one reason why the Securing a Strong Retirement Act of 2022, also known as the Secure Act 2.0, was signed into law by President Brandon on December 29th after passing in the House by a landslide vote of 414 to 5 last March. Among other things, the act requires most employers to automatically enroll their workers in their retirement plans. Here's how to be proactive and get the money you're owed now. I wouldn't say you're owed. It's part of your benefit package. Millions don't max out their 401k match. A 401k match is a common program that sees your company double whatever you contribute to a workplace retirement account up to a certain limit. This perk is part of your compensation package when you get a job. So if you don't take full advantage, it's like you're not taking part of your salary. Say you make $60,000 a year and your employer offers a dollar for dollar match up to 6% of your salary. That means the maximum your employer will give you is $3,600 each year. But if you only put $2,000 into your 401k, it's only putting $2,000 in and you're leaving $1,600 on the table. Opportunities like these don't come around often in life, and yet 17.5 million Americans are guilty of not cashing in on the full offer they receive, according to a survey by Magnify Money. How will the Secure Act 2.0 change things? It's not like retirement saving isn't important to Americans, with 71% of people calling living comfortably in retirement a top goal in life in a 2022 Principal Financial Group survey. Yet roughly half of Americans aren't confident their savings are enough to have or have confidence in their retirement planning. Under the Secure Act 2.0, workers will be automatically enrolled in a 401k at a contribution rate of 3% of their pay, assuming you don't opt out. The contribution rate would then increase by 1% annually until it hits a maximum of 10%. The legislation also expands what you can do with your 401k contributions, and many employers are buying in. A 2022 survey of over 360 employers by business advisory firm WTW found 38% plan to allow employees to divert their contributions to things like reducing student loan debt, adding to emergency savings, or topping up a health savings account, all while still receiving a company match on those amounts. About 28% of employers surveyed also plan to boost their plans by doing things like increasing the automatic deferral amount. Why don't people contribute more? The Principal survey says 62% of workers list employer match contributions as top criteria for reaching their retirement goals. But when it comes to knowing about and contributing to 401k plans, the Magnify Money survey shows a small number of respondents say they don't understand how these retirement plans work, about 6%, or don't know whether their company offers a match, 17%. Some employees, 12%, say they want to wait until they're older to contribute. But as any financial expert will tell you, contributing as soon as possible is critical, since it gives your investments more time to grow. The biggest reason why employees don't take full advantage is affordability. Over a third of respondents to Magnify Money survey say they just can't contribute as much as they like. That makes sense, especially at a time when many families' budgets are being stretched to the breaking point. Again, remember who caused that problem: the Fed and the government. All right, so how to start taking full advantage. When excuse me, when this much money is on the line, you'll want to set up a talk with your HR representative right away. Prioritizing your 401k over other savings and investing options is often a smart move, at least until you max out your company match. One exception could be building up your emergency savings in a crisis. Pulling money out of your 401k can easily trigger costly penalties. Taxes and penalties, not good. If you've got enough money to spare, your first step should be setting up an automatic withdrawals from your paycheck. A set it and forget it approach will ensure you get the maximum match. Keep in mind that the new legislation means you could have multiple options for what you can do with your contributions in the future. Remember, you can always invest more than the amount your employer will match. And since these automatic withdrawals typically come from your pre-tax income, you won't need to pay taxes on your contributions. All right, so all good details there. And if you need any help, setting up or figuring out how much you need to be saving for your retirement, give me a buzz. I'd be happy to run the numbers for you. You can reach me at DSA Financial Group. All my contact information's there. And if you have other questions about saving for college, not that I would want to send my kids off to college today, but it's more of a woke indoctrination. But some people still want to send their kids off to university. Anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, like I said earlier, you can reach me at dsafinancialgroup.com. And I hope everyone has a wonderful evening. I'll talk to you guys next time. Adios.